Hey traders, Raghee here. Welcome to our weekly notes discussion live. Great to see everybody. Should be a pretty good one. I don't have a lot of bigger picture discussion to sort of begin with because ultimately what we have is this is a stock pickers market, gang. We've been talking about the macroeconomic reasons that we've been focused on certain corners of the market. And I kind of, let me see here. There we go. So here's what the weekly report looks like. All right, so normally I would be pulling up the FOMC target rate probabilities. Gang, higher rates are coming. Probably a half point hike, maybe a quarter. Either way, we're going to see that coming. Plenty. Now, look, we're getting the FOMC minutes this Wednesday. This entire hot zone section is pretty much dominated by all the different Fed chuckleheads. That's what CNFOMC stands for, in case you didn't know. So we have all of them coming out. I mean, so many. And again, we're having FOMC minutes on Wednesday. Now, in fairness, I think there's been a very clear and concerted message about higher rates are coming, whether they're quarter point hikes or half point hikes. There's no question that we're going to see the rate hikes continue to come. Now, in the backdrop of all this comes earnings season. Now, earnings season is tail wag the dog season, right? This earnings season is all about individual stocks, outsized price movement because of the volatility that we could see. And then you add to that the weighting of these individual stocks within the sectors and within the indices, individual stocks, being a stock picker. Gang, the move that we saw at the last 2 weeks of March with the indices, those are unusual moves. They came out of nowhere. It was a short squeeze. A short squeeze just kind of kept going. And those are usually fairly unusual moves. I would not count on moves like that going forward. When they happen, terrific. If you're a Momo trader, it's great. If you're a trader like myself looking to take advantage of exhaustion, you know that is not the kind of market that you're going to have a lot of luck in, but that's okay. Because knowing that we need to be stock pickers, our book has been plenty busy, but it's really been about where are the trends, either at the index level, nope. At the sector level, very few. And at the stock level, actually, it's pretty good. So that's why I've kicked off this week's overall view of, I'm a trader who specializes in sectors, right? I love ETFs. That's my thing here at Simpler. But I can tell you this, to look at the market sector by sector or even index by index right now really is of no value because most of the sectors, that broader tide does not have a lot of clarity. Don't get stuck there. Gosh, I need to find that iceberg. This would be such a great image to add to the, this is it. This pretty popular one right here. This is it. This is where we sit in these markets right now. And, just to get a darn picture already, but you know where I'm going with this, right? Right now, when you see that sector, that broader index, dive under. You've got to dive under and say, all right, what else is going on within it? And when you look at what else is going on within it, gosh, these things are as gorgeous as they are creepy, aren't they? They are just beautiful, but so creepy. Yeah, unbelievable. Anyway, dive underneath and see what's going on. And whether that's diving underneath and seeing macroeconomic trends, whether that's diving underneath and finding the individual stocks that are weighted within that sector or index that look clearer. Clearer almost always means a trend. That's where we need to be this week. So sector by sector, frankly, it almost doesn't even matter. It's just sometimes, look, sometimes traders just kind of get locked in. I can do this, and I have been before. We can get locked into a process without understanding what the end result is ideally meant to be. When we go through analysis, when you take a look at the notes that I have for you all this week, it's really targeted. This is a stock picker's market. This is the market of specificity. This is not all the tides or the tides moving up, taking all the boats with it, or the tides are going out, taking all the boats with it. That is not the situation. In some sectors, you'll see an uptrend stock and you'll see a downtrend stock within the top 11, and that's not really that uncommon. So keep that in mind. Don't get stuck into, well, let's break down every single sector. Right now, that's useless, right? And this is coming from the sector girl here. That's simpler. Don't do it. It's not going to serve you well right now. So with that being said, let's go ahead and jump into the questions, because after all, that is what our shows here are all about. So we have plenty of time. Yeah, we have another 25 minutes or so to go all through these questions together. I actually am drinking a little coffee today. Just finishing up a little afternoon coffee, evening coffee. Hopefully it doesn't keep me up. All right, let's get to it. Hey there, Michael. What are my thoughts on FCG? All right. So if I look at FCG, so you're looking at another natural gas ETF, and whether you're looking at FCG or UNG, I haven't. I'll tell you straight up, I haven't looked at FCG in a really long time, and I'm going to check something here really quick. Sorry, gang, had a little sneeze attack there. All right. So nice to be able to mute that mic and not deafen you all with the sneeze. So I'm looking at FCG, and the last time I looked at FCG, Michael, yeah, that's okay. So I love the structure. That's number one. If you're buying the underlying, no problem, because a lot of actually, I wouldn't say a lot, but it was just last week that one of the members in the Sector Secrets Mastery said, Rog, I bought the underlying stock. I don't really trade options. So that's no problem, because our triggers, even for the options, are the underlying stock. So if you're playing the underlying stock, very inexpensive name, sure, that's the way you would have to likely go here, because Michael, the liquidity on the open interest in terms of how many contracts are you really working with? And then remember, illiquid strikes, illiquid options chains also present problems with getting in, getting out, getting your price. So it's a good look at the broader. Now, as far as the boats and tide on FCG, well, let's take a look, because bear with me here. Let's take a look at the boats and tide here. So if I pull up FCG, great looking symbol. So then once we get inside this this ETF, the question then becomes, well, what's in it? And are the individual holdings liquid? So you've got Occidental. Some of these names you're going to notice are going to pop up. So Occidental, I'm seeing here, ConocoPhillips, EOG Resources, Pioneer, Marathon, Devon. You're going to see Hess, Fang. You're going to see some of these names pop up in some of the other OIH, XLE, XOP. You're going to see, but that's a really, what I would say, what I would do. So this is one of the layouts that we use in the mastery. So what I would do is, and I'm going to build this out and show you all how I like to populate this and scan it. All right. This is a great look at old school scanning. Gang, I am a big fan of old school scanning. Once upon a time, I'll tell you a little bedtime story. Once upon a time, we did not have computers. I am sure lots of you remember not being able to put on trades on your computer and streaming charts and all these fancy indicators. That was how I cut my teeth as a trader. Most of my indicators either were the ones that I was lucky enough to see built into the charts that arrived to my home once a week, and then I would manually have to update them the rest of the week. And then I get a brand new set of charts the following week. And whatever indicator I wanted to use, I had to calculate. Now, eventually, I got a DTN machine. Boy, did I think I was hot stuff then. And I had a dish on the side of my house before Dish and DirecTV were a thing. I had a dish on the side of my house getting data. And that little setup cost me about $1,600 a month just to get some commodity feeds that were delayed between the fee and the setup. Oh my gosh. So what really happened is, I think when you talk to traders who cut their teeth in, say, the late 80s, early 90s, like I did, you end up really not relying on indicators a ton, or most of what you do have to be something you can calculate. And when you're scanning the market, you're not using scanners. I mean, I didn't grow up with scanners. I didn't see my first scanner until probably 1998. This was how my mentors and we would look at chart after chart after chart. We would group them together to know that they were moving with each other or moving each other. And you would just manually pour over charts. And I really haven't lost that. And I almost feel bad for traders who didn't grow up with that, because scans are very different than looking at curated groups of symbols that tend to move together and affect one another. So what we're doing with FCG is my old school on sort of the new school platform. So I've got SWN, AR, PXD. So these are the top 11 names. And by the time I get down to MRO, I'm at about 3.41%. When I'm up at Occidental, I'm at about 4.5%. So this is not a high concentration weighted ETF. So that means the individual stocks are cool to have, but really not one of them is going to be disproportionately influential over the overall group. However, when you think about Occidental, EQT, and DCP, you're looking at about 14%, 12 and change percent of this ETF. So when you have this many stocks within a tide that are moving higher, if at all possible, play the tide. Since that's not possible here, look for the liquid names that are more likely to sort of be a proxy for the tide. So cool question to kick that off. And I hope this little process was helpful in terms of, what I am doing, on a Sunday evening, on a Monday morning to get ready. Really embrace, gang, sort of old school, to the point where, update your multi-charts by yourself. Go back and look at chart after chart after chart. I promise you it's going to teach you so much more than scanning 3,000 stocks, having something spit out a whole list, and you don't know where the correlation or the causation is within that list, where, and then eventually you'd have to go back and look, right? And that's where I think a lot of traders get into trouble in the modern era of the markets, where we've got these lists that are spit out based on usually technical indicators, which is fine, but it disconnects us from sometimes the real reason these things are moving, which is they're part of a niche, they're part of a sector, they're part of an index, they're part of a theme, and that theme is moving. And then within that, now we can get to the best part of it. And this is Sector Secrets 101. What are the outperformers? So awesome question, Michael. All right, SOYB. So last week, Tom, we had, I think on the 31st, we had a USDA report. We know there's oftentimes going to be a lot of volatility. Think of it as an earnings hot zone or a non-farm payroll, or even probably more accurately, a central bank event. But it's being applied to grains, whether it's ZS or whether it's SOYB, it's being applied to grains. So corn, CORN, this looks better. DBA is still holding its own. I do like SOYB and ZS for my futures traders out there. ZM as well. So just be careful with beans right now, because clearly its narrative is disconnected from the corn narrative, and corn is still hanging on to the wave. It's a relative outperformer. So think of it this way, Tom, if you're looking at SOYB for the first time, fresh eyes, right? Not biased by either previous gains in SOYB or even an existing position. If you were to look at this for the first time, imagining that you're just meeting SOYB for the first time, no existing position bias, nothing, would this be something you'd be willing to buy into? There are some incredible volume ledges here. Nice Darvis in the same area. Could be an oversold buy. Slow stochastic is not quite there yet, but it's getting there. It's getting closer and closer to that 20. But I would say let's keep an eye on corn, because this is where we come back to not what can I do with SOB, SOYB, which is maybe being an SOB right now. Not what can I do with SOYB? Should I do anything with SOYB? Does that make sense? Before the setup comes, should I be trading this? Is this the best example of a strong grain market? And if we always put ourselves through that type of questioning, if we always put ourselves through, should I be trading this? Not what's the trade here? You're going to find a higher quality of symbols on your watch list. Okay. Is there a list of ETFs that we should be looking at as a member of the mastery? No, there's not a full list. So much of what we do in the mastery is going to be based on oftentimes what most traders should be focused on, which is where's the liquidity, right? But one of the easiest ways to build out, or at least a familiarity with the sectors, especially again with the way that I operate the mastery, is Michael, head on over to Koifin. I've shared this with the entire community at Simpler before. And head on over to Koifin and take a look at the U.S. sectors, and then take a look at the U.S. industries. And if you want a list, and I'm not always going to trade all of these, but what a great cross-section of the pieces of the economy, of the pieces of the equity market to be familiar with. And you'll notice some of these are not high concentration weighted ETFs. OIH is, KRE is not, right? XRT is not. Then you'll take a look at certain ETFs like MOO, and you'll notice when you pull it up on the on your TOS platform or whatever you're using, you'll notice not a lot of liquidity. Not terrible, but not a lot of liquidity. So that's where you'll get a really good familiarity. But if you were to acquaint yourself with these industries and sectors, I think you'd be right as rain. So head on over to Koifin, and you don't have to buy this service. You can use an email address, sign up for free. I'm not even sure that you need to even sign up. I'll throw this link in the notes for you all. In the mastery, I just sent you out your watch list as well. So I'll throw the link in there. But that's what I would say. Start with that list, Michael. All right. Okay, moving on. Can we see Nvidia? Yes. There we go. All right. So not a trending chart. This thing if it has trended, it's been down this year in 2022. And it, much like a lot of other names over the past 2 weeks in March, rallied up. But even with all that strength, could not turn into a double green. So you do have to sign up to use it. Oh, okay. So either way, you do need a free login. Okay, you do? Okay, good to know. I've been using it for so many years, I don't remember. But yeah, it's worth having. It's definitely worth having. So not an uptrend, lots of bullish momentum. This is why when I talk about market structure, we talk about bullish momentum, neutral trend, or bearish momentum, neutral trend, or bullish momentum, bullish trend. We always break it down. And this is a bullish momentum, neutral trend. So we're still talking about potentially an overbought, oversold kind of market here. And then you can see the response that we had. Take a look at this. When we got to this volume ledge right there, beautiful. And then if you were to extend over the Darvis, pretty darn impressive, right? And then what else do we see here? Let me show you. To the slow stochastic, that shift from green to red right in there, that's your KD cross, right? If you've got the different crosses you're tracking on the slow stochastic that I share with you all, those specific settings, 21K, 3D, you'll see it started to cross. So we're above the 80, which is that high level, if you will. And there's your cross right in there. So you get a stochastic cross, you've got the Darvis, you've got the volume ledge. I mean, that's a lot of the pieces coming together there. All right, but I don't have a trend here and it's already exhausted. So be careful on this one. I can't say, Giancarlos, that it would be one near the top of my list because I'm just not going to be prioritizing non-trending markets all that much. All right, Joe, we talked about SOYB. Let's take a look at DBA. DBA is a symbol that I think we took our first target on this one. This was a mastery trade. We took our first target. I think we hit the break even last week, and I'm gearing up for another entry. So, Joe, I want to get long DBA again. Absolutely. I do want to get long. Double green, pull back into the wave. We got break even stopped on Friday, which means we hit our first target, scaled out of half the position, and then we risk a little bit, not our capital, but unrealized profits, so we could, at least protect our downside. We paid ourselves, and then now we can, we freed up capital both in our account and also in terms of our book, so we can get after it again. And I'd say I'll be looking probably close to I'll probably be looking close to 2160 perhaps for an entry, another entry. All right. Okay, next up is the main focus in the mastery to trade unbalanced ETFs? Unbalanced. Oh, high concentration weighted, Tim? Yes. Oh gosh, yes. Now remember, S&P, NASDAQ, Dow, they're all high concentration weighted. So meaning a very few number of stocks have a disproportionate weighting. So unbalanced, it's another way of, sure, that's another, I've never heard anyone describe it that way, but that's very appropriate. Yes, we want to focus on those, but then even if we didn't, let me mention that most of the ETFs are, as you said, unbalanced. So it's not that it's a conscious choice, just most of them are. And then most of the impactful ones are. And then also the advantage that gives us is we can look within a group of stocks and say, oh, there's about 6 names that are going to have a disproportionate influence. Therefore, we'll have a much better idea of where it's likely to go. So we use it to our advantage. Absolutely. New member? Awesome. Awesome. Most excellent. All right. Happy Sunday. Appreciate your conviction with the US dollar rising. Is it too late to buy an FXE long put? Yes, but you never know. With as many FOMC speakers that we have this week, who knows if the dollar rips lower or heads lower, and the FXE, the euro, the 6E, the euro US, who knows if they head higher, and that would be basically resetting that either UUP call, FXE put. And by the way, I've also mentioned to members that put the British pound on your watch list, right? It's way, way, way down below any kind of setup. But I would tell you this, put it on the watch list. So right now, yes, I believe we hit our first target. So we're more in the target zone than we are the entry zone on our FXE trade from the Sector Secrets Mastery. However, never be disheartened if that market can go double red again, if we can rip higher towards, say, 103, 103.5, put an alert out there. You never know. That's always the way I presume the markets. I don't know what's going to happen next. I do know what I want to do if it gets there. And you see this volume legend here, 103.35 to say 103.60. Keep an eye on that in FXE, my friend. All right. Okay, next up, Wes asks, how can gold be bullish if the 10-year is also rising? I look at, Wes, this is the way I was taught, and this is what's worked for me. I look at gold, and I don't believe gold moves inversely I don't believe gold has a strong correlation to the 10-year. I don't actually believe it has a steady correlation, although sometimes it's strong, but I don't believe it has a steady correlation to the dollar either. Usually gold moves inversely to real yield, which is the nominal yield of a bond minus the rate of inflation. So here are the real yields, right? Let me zoom in a little bit. And let's see, how far can I get on this? Let me see how far I can zoom. All right, so this is there you go, July to March, May. Actually, that's about May of last year to March of this year. And you can see here the nominal interest rate. So I'm looking at real interest rates. Here, that's your real interest rate. See how it's kind of creeping lower, but it's sideways. I know this is kind of odd at first, but it's this blue line that we're interested in down in here. So there's your interest rate. That's this red line here. It's going to pop up for me. There you go. There's your inflation rates. Remember I said it's the nominal yield of a bond minus the rate of inflation. So it's the blue line and the red line that are creating your real yield. Well, sorry, it's your white line and your red line that are creating your real yield. Real yield, the blue line, is sideways to slightly lower. Do you notice how gold, let's go back to gold here, is sideways but slightly higher? I know it's not going to be a perfect sort of mirror image, if you will, but that's what I look at. So I don't look at gold in the 10-year necessarily exchanging notes. That's not historically how I viewed it. And I don't have my, darn it. Maybe tomorrow we can go over it. I have my, I don't have my core. I have a correlations page I look at from time to time to see what the inverse correlation may be at the moment. So I don't have that handy, but look at the real yields. And unless real yields really start to tick lower, it's going to be difficult for gold to move higher. But as long as real yields are slightly going lower, but chopping, gold's going to be generally moving higher, but also chopping. So that's the way that I look at that. That's the way I look at gold. It's always a situation for real yields for me. I'm sure there are other ways to break it down, but I've never broken it down any other way and found sort of the history of success that I found by looking at real yields and gold. So check it out. I don't know that gold has to go down in the scenario that you're, and that's great research. I just don't think gold has to go down necessarily in that scenario, or at least it's not yet. So that's the way that I'm looking at it. Real yields. I hope that makes sense. Terrific question. Really good question. And look, gang, I can only share with you all what I actually do. I'm not gonna, I was just tweeting the other day, whenever I watch TV and have the misery of unmuting financial television, it's just so blatantly obvious when a guest just really is not staying in their lane in the conversation. And because they're on television, they're not going to say, gosh, I don't know. I don't measure the market that way. This is what I'm measuring. This is why I'm bullish or bearish or long or short or what have you. So I'm going to say the same thing. I'll do what I wish they would do on television. I don't know about, whether or not gold should move lower because, what's happening with FOMC monetary policy. What I have found, though, is remember that monetary policy conversation is going to be baked into really the yield, the bond yield. So I think you've got one piece of the formula. Just add in that inflation rate and get that real yield. And I think you're just going to run with that, Wes. I think, already knowing where your head's at, it's going to come so naturally to you to look at that trend and see if you like it or not. Because you're already, even in terms of what you're looking at, you're already looking at the pieces. So all I'm saying is maybe put them together. So terrific question. When the red, yellow, hey there, Mr. Walker, when the red, yellow, and green propulsion dots slow, does that indicate an EMA crossover? So, Mr. Walker, when the dots disappear, that means that the structure of one moving average having crossed another, staying above or below it, and interacting with price in a particular way, that criteria has now gone away. And yes, there could be a chance we start to stall, chop, and then the last thing is potentially reverse. So does it indicate? No, I think everything that we look at on our chart is a warning. I would love to say that this happens. Look, it's happening right now with the inversion, right? Everyone's talking about the yield inversion. Gang, it's people will always say it's a harbinger to whatever every time. Bad idea, especially with the globally, the central banks doing as much as they've done to disrupt a lot of these very normal relationships. They're not that normal anymore. So I always want to hesitate to, well, if this happens, then that, in some sort of confident manner. But it should give us a warning. It's a shot across the bow. Does that make sense? When those dots disappear, when they have been lit up for a while, well, case in point, let's take a look at gold here. To Wes's question, we're chopping around in gold. Yellow dots weren't printing for very long. 21 was printing for quite some time and stopped. And then what happened after that? We dropped, blue grab candle. We've been chopping ever since. Is this necessarily indicating a reversal? No, but it indicated that the uptrend has lost its swagger. And if an uptrend starts to slow, the sort of natural evolution of that is it's probably going to chop. but it's still bullish, right? So I hope that makes sense. I love healthcare, Mark. Yeah, I love healthcare. I put a couple of healthcare names on the list for the mastery, so you can check that out. I'm actually looking at the list. Mm. Yeah, XLV itself is definitely worth watching. So is Bristol Myers Squibb, but we've had that on the radar for a while. We just need that pullback. But I don't think there are that many boats inside of healthcare that are affordable and that I like. But healthcare itself, which is a great bang for the buck, it's one of the very, very, very few sectors, Mark, that we're going to talk about where we want the tide and not an individual boat. But I don't know about whether it's good in an inflationary market. Obviously, it might be, but I can't say that I've got a lot of experience of saying, "Hey, inflation means this." I mean, I imagine it can happen, but what I will say is it's above the 200. It's a double green market, and there are some very good-looking uptrends within. Right, there's some good-looking uptrends within healthcare. So if we can get a hold of healthcare, Mark, we will do that. If we can get that dip. It's one of the very few sectors that we will look at. Yeah, we will look at in terms of a buy the dip. Yeah, absolutely. Let's see. Do I have a comprehensive list of sectors and markets that do? I can't say that I have a comprehensive list of that, Wes, because I don't think it's always the same way every time. I think there are certain reactions that we would see utilities and staples have in a risk aversion market, or things that the dollar might do when the monetary policy is tightening. But I can't say it's always the same. It does change from time to time. So I would have to say generally no. Generally no. We just try to observe what is moving in the current environment, both macroeconomically, technically, and then things moving on their own merit. Look, we could say that healthcare maybe is inflationary, but I don't know. We could say that energy stocks, well, you could say the energy stock is inflationary, but then there's also this geopolitical issue going on as well. So I think that inflation, that narrative of inflation, usually it's a lot broader and easier than people might think. If we have an inflationary market, we focus on, as I like to call them, grocery store commodities. And that's going to take us to grains and meats and softs. That's one of the reasons in the mastery we're long Brazil, right? I mean, this has been a monster trade for us. What are those economies that are going to benefit as the price of commodities goes higher? Look at EWA. EWA is generally called a dollar, commodity dollar. When an economy is heavily reliant on their exporting certain commodities to the globe. I mean, look at EWC, Canada, energy, lumber, right? So there are places we can look. It's usually just not that fixed, but it's not that complicated either. What am I seeing in Tesla? Look, Tesla's got a whole, John, right now, two things I always say about Tesla. Don't short a fanboy stock. And I would hardly consider it right now smart to in light of the split. Retail traders lose their minds, their common sense, and everything else when they start piling into a name in front of a stock split, because you can buy it post split, usually about a 10% discount, because that's usually how the rhythm goes. But I would be very careful here. This stock is moving because of, well, I mean, delivery numbers have been quite good. I don't follow Tesla that closely any more than its impact on the Qs and on the NAS and on the XLY merit I need to. But I would tell you, with that stock split news coming, if I'm a hermit on a cave, I'm looking at potentially a retracement. But having gone double green, you can see that now 2 days of double green. This is a buy the dip market, and it's a buy the dip technically. And I'd say, again, knowing retail trader behavior in front of a split, it's more a buy than anything. All right. Okay, gang. As always, thank you so much for joining me for our notes. I know there's a lot of questions there still left, but remember, we're also going to get together Monday, Tuesday, Wednesday, Thursday, Friday, 9 to 9:20 get those questions in early. I take them first come, first serve. So I'll see you for Charts and Coffee tomorrow. As always, gang, thank you so much for your time. And I will see you all tomorrow. All right. Be good to each other, gang. And again, thanks so much. When we started this Sunday experiment, I wasn't sure how it was going to go. And I thought, we'll do 30 minutes and see if anybody shows up and if they're interested. So I appreciate and I respect all of you putting in the time during separation season. Sunday, Sundays, we're getting a jump on the week. So deepest respects. All right, gang, I'll see you tomorrow morning. Be good to each other.